So in case that you don't want to be recorded, just don't say anything. But outside of that, hey, look, I really am excited to be here. A lot of this is something that I love to do. I love to talk to people about how to empower themselves and finances and going through there. So today, one of the things that I want you all to be able to be active listeners. If you're listening for the first time, some of you all might be hearing this for a second time or third time today. I hope you get some education, get some information that could help empower you and help you become better. So I promise you one thing though, I won't be super long, right? I kind of like a Baptist minister, I'm only going to be a minute. So those of you that go to church with Baptists, know that might be a little bit longer, but I'm here only to try to give you some quick information. The main goal of this is, if you like the information, is to get back with the person who invited you, so that we could get you some more details. Okay. So the first and foremost of this this actual presentation is really focusing on an area that I think is important for everyone, which is retirement. But we always look at financial wellness in general, but this is going to be really focusing on retirement. Okay. And with that, retirement is so important that your retirement and your golden age or whatever time, retirement is not really a age number, is probably more of a financial number, that where you could feel satisfied and able to not have to go to work. Not that you might not work, but you don't have to work, right? So one of the things I'm going to go through is some educational parts first, and then go into to the retirement area. But this is something that like I said, I've done for almost 20 years. And this is where, we want to help people in these areas. One, the alarming lack of financial education about fundamentals, right? Right now, they say that most people do not have the basics of how to be better themselves financially. All they hear is stuff on TV, but they don't get the details. And that's where our company want to come in and give those details on and help people with the areas that they don't hear about. People are living, of course, dangerously above their means. Debt is actually rising to that even higher now. Insignificant insurance protection is rampant. That's one of the key concerns. And with COVID just passed, that's been not passed, but we're in this challenging time. More and more people realizing that they need to do something there. Consumer debt, and of course, poor saving habits, right? If you have debt and no savings, that's a really bad combination. So one of the things that we want to do is really kind of help people change that. But again, we're going to focus on 3 scenarios in life to prepare for. Number 1, what happens if you die too soon? Number 2, what if you live too long, which is your retirement? And number 3 is getting too sick. And our focus really is number 2, but I'm going to touch on 1 and 3 because it's important. But you have to have a scenario that take care of all those things. Number 1, let's look at your life, right? And what's happening now. If you're like me, I'm married. I have actually 5 kids, right? A little bit older right now. I'm like 50, but you might have a different construct if you're single versus a person that might be, just married with no kids. Wherever each person home is a little bit different, but what we're going to do is look at the average family of 4, if an average household income of $50,000. This is what the numbers say for that couple, for that family. Their debt is about $50,000 total, right? At least right now. That's probably outside their mortgage, of course. Their income, they're probably making $50,000 to $60,000. So if you look at that over the next 10 years, they were bringing $500,000 to $600,000, right? If their income is around that range. Their mortgage is somewhere around $250,000. And if they have children, that say in this example, I have 2, it's about $100,000 per child for them to go to school. And that is probably very conservative. Okay, so what that means is that family will have a what we call a dime method, or a dime calculation of their debt, income, mortgage, and education of $1 million of coverage. That if something happens to the breadwinner, they actually need $1 million to cover over that the family still keeps going. That makes sense. Now, again, every single person and every single family will be a little bit different. But this is something that you want to try to do for yourself or for your family. Like, hey, look at your debt, income, mortgage, education. Do you have enough protection? Because most people don't. All right. And most people have, they don't really even know what amount they need. Now, there's a couple of ways to look at life insurance. There's term and there's permanent. So their term insurance is a little bit less costly. Now, term, the premiums will increase and there's no equity or no money being built in and it will end. So most terms is there for 10, 20, 30 years and then they stop. Then of course it gets more and more expensive or you have to stop it, right? So that's term insurance, kind of like renting the car, right? You're renting the car, nothing wrong with it. It's not evil or wrong or whatever is good. It's going to be a little bit less. However, as you get older, it's going to become more and more costly. You're going to get, it actually becomes to a point where you can't purchase it anymore, right? Now, permanent insurance, now most people haven't heard of quote, quote, permanent insurance, but insurance that's there for your all your life, all right? This is a little bit more costly because you're looking at things that's going to create a level premium for the rest of your life. So they kind of making that set situation for all your life. You have an equity or your money going to be built up, cash value, they call it, right? You're going to build up cash value and it's there, of course, until you pass away. So the ones that's like that is called whole life. If you heard of universal life, index universal life, all those are permanent policies and that people could use. And there's different versions of those out there. Okay. Now, long-term care is very, very important. And I just said, actually, my father-in-law is going through some challenges now, and long-term care would be have been kind of things that looking at it, and we realize it's one of the things that's very, very costly. If you look at the cost of if you're going to try to do it out of pocket, or you have to become actually what they call destitute, you have to get rid of all your wealth to take advantage of things from the government per se, right? And most people don't ever prepare for it. And that's where you could really steal a lot of your money or a lot of your wealth being passed on from generation to generation that can be taken away from long-term care. So you really want to be prepared for that and having programs or policies that will be able to take care of these needs. If it's an in-home nurse or if you're going to a nursing home or just getting assistant living, all those things, those are very, very costly if you don't know what to do, right? I tell you, even if you know what to do, they're costly and they're not going down, they're going up, okay? So you want to have something that will prepare you for that. But, our focus today was retirement, right? And we said, this is just some statistics that's out there. At the age of 50, 75% of the population, now catch this, don't have $5,000 in the bank for retirement. They don't have $5,000 put away at 50, right? And if you talk to most people, they're probably like, if they could, right, they might want to retire at 60, 65 or something like that. But if you don't have $5,000 at 50, it's going to be a very challenging time. You better make a lot of money, right? This is a challenge, though, that age 65, because if it follows the statistics, 75% of Americans depend on relatives, 30% depends on charity, 23% are still working, right? So that means there's only 2% of people that as age 65 and older that is completely self-sustaining. So what does that mean? That doesn't mean that have to be you. That just means that you have to prepare and make some changes so that you can be in the better position at retirement. And also, I would say we want to increase that number, right? I mean, I don't think that would be that hard to increase from 2% to get it up. I would love to double that to 4%, then double it again to 8%. But you know what? It goes all the way back to education. And if you're not educating yourself on the finances all the way through, this is what can happen. Now, here's the thing, right? This is where the nightmare comes in, right? Would you say this is a nightmare when you're in your retirement age and you're not getting sick, you have to sell your home, you have to go back to work or never stop working, leaving a legacy of debt because you wasn't able to pay off all your bills? Would you say that's the nightmare of retirement, right? And we've seen these nightmares. I've seen going to the Walmarts or the different Home Depots and and people that you just like, wow, I don't think they should be working, doing all kinds of things. I literally have, because I'm in this industry, work with people in different industries from all over, and they're like dying at their jobs, right? From truck drivers to people in nursing. I mean, they're old and they can't stop because they haven't prepared. It's a nightmare. And I don't want that. We don't want that for you. We want to be able to change that for you. We want you to have the dream retirement, right? To be able to do what you want, when you want, whenever you want, as long as you want, with who you want, right? And you could go to travel. We could go ahead and have freedom, and you can give back to society, give back to your children, give back to your grandkids, give back to your great grandkids, or some of y'all, whatever, right? Maybe find out what you would like to do and support. All right, this is a chance that that for so many people, as you actually that I know who have actually prepared correctly. This is where, not that life starts, but life gets wonderful because they're able to do all the things they really want to do and support all the things they really want to support, instead of living for paycheck for paycheck. Right. So this is where we want you to get to. So have you ever asked yourself, what's your financial independent number? This is something I learned from a really great friend of mine a while back, a financial independent number. That's how much you want to live off per year after you retire. Let's just say you want to live off $100,000 per year. That's that's what you felt would be fine for, and you felt you was going to at least go on for another 25 years. That you would probably need 2.5 million, right? You would need 2.5 million, so that you could live off 100,000, right? The thing is, one of the things I feel, even early on when we start working or coming out of college, no one ever asks us that. No one ever, say, hey, what's the minimum number you want? And of course, you might be hard to think about it, but it doesn't matter. The thing is, you have a number to shoot for. This would be easier to accumulate. The thing is that wherever you at now, right? This is the youngest you'll ever be. Right? Whatever age you are right now, guess what? That's the youngest you will ever be again. Right? So better to start now and start planning now. Now, to start planning, is smart to plan easily, right? The strategically, and things that will impact you. So here's a couple of things we're going to talk about. Compounding interest, the rule of 72. If you haven't heard of it, this is an amazing, amazing rule. Rule of 72, actually, Albert Einstein said, compounding interest is the eighth wonder of the world, and he who understands it earns it, but he who doesn't pays it. And one thing I realized is that this rule is kind of like based on everything that we're doing, that earning interest, that you could put the two, and kind of like, if you're not using it correctly, or if you're not taking advantage of it, you're being taken advantage of. Okay, so let's just take how the rule works. So you take 72, you divide it by your interest rate, and that will give you the number of years for your money to double. So 72, take it divided by your interest rate, give you a number of years for your money to double. So let's just say, for example, if you was had like you had something going at 4%, right? And you was at age 29 and you had $10,000, you put it in something that was giving you only 4% for the rest of your life. So by the time you're age 65, right? Well, let me break this down just to make sure. 18 more years, you'd be 47, you have 20,000, another 18 more years, you'd be 65, and you will have $40,000. That makes sense. You will have $40,000 after that period of time. Now, I don't know about you, but that's not retirement money right there, of course, right? That's of course, but if this is the same thing, you would say, hey, you had that money, something was giving you 12%. At the same time, you started at 29, you have $10,000. At 35, you have 20,000. So this means now every 6 years, your money is doubling. So now, so if you 12% as every 6 years, at 41, you have 40,000. At 47, you will have 80,000. At 53, you have 160,000. At 59, 320,000. And at age 65, you will have $640,000. So that will show you as a $600,000 difference between the two. Now, let me ask you this. Do anyone here want to miss out on $600,000 if they don't have to? And this is the thing that people are missing out every day. They're missing out on that money. They're missing out on the understanding of how to accumulate that wealth, and they're not getting the information how to make it happen. And that's where I'm so excited about what we're doing. We're showing people how to make sure they get better rate of returns. Now, also, you need to reduce your taxes. Would you agree with me? Reducing taxes is very, very important. Not evade, but avoid taxes. Evading taxes is legal. Avoiding taxes is smart. Okay, so let's talk about this real quickly. There's 3 types of tax brackets you could be in. When I say that, how your money will be taxed. There will be either tax now, tax later, or you be in a tax-free, or what we call tax free future, right? No more taxes in the future, right? So either you tax now and forever, I should say, tax later, right? Or tax free. By the way, if anyone have anything they want to ask, put it in the chat. That's, questions, comments, any of that kind of stuff, put it in the chat. It's very important. Every question is good. We would love to keep that with you. And I'm very, very, very conscious of time. Want to make sure that we get this information into you and still have some time for you if you have some questions. Okay. So let's look at tax now. What does that mean? That's things that's taxed right now. So your money, when you have your money, you got it from your paycheck or whatever, you put it in here. When you got it from your paycheck, it was taxed. You put it in these type of programs, these type of areas, they're going to be taxed again and taxed every year, and taxed when you use it and taxed when you pass it on. It's always going to be taxed. I call it now and forever, right? So if you put in a savings account, CD, even if you have mutual funds, stocks, all that's taxed every single year, on the growth every year, all the time, no matter what. Also, real estate is in that, right? All these areas are what we call tax now. So you can't get away. You're not getting away from the taxes. So that impacts your money. Not a lot, because if you're thinking about whatever tax rates you're looking at, that subtract that from the value of your money, right? Minimally. But one of the things that we realize is that taxes takes almost 40%, almost 40% of our money, right? So just think about that. That's tax now. Now the area is what we call tax later. That means that it's not taxed at this current moment, but later on it's going to be taxed when you go and take it out. A lot of you guys might have a 401k, a 403b, some type of retirement, TSP, IRA, and you may have left a job, right? TSP, 401k, 403bs, and you pulled out some money and you realize, oh my God, I got taxed, got penalized, got smacked in the head, all kinds of stuff, right? You just didn't feel good, right? Well, that's your 401ks, your 403bs, your IRAs, pensions, Social Security, all that. All that's taxed later, right? So that means when you go use it, when you go pull it out, you're going to be taxed, right? Pass it on, going to be taxed. Taxed at the current rates, right? At that time. So one of the things that it's not a bad place. Don't get me wrong right now, because people use it to reduce their taxable positions at this current time. However, you have to realize that the money still going to get taxed. Now, this is a very important area. We call it tax-free. Wealthy people love this area, right? I think everybody loves this area, but wealthy people love this area. But it's hard to get into it unless you know what to do. Roth IRAs, right? Is a big one that most people know of. Actually, that's probably the only one that people know of. Municipal bonds, probably some people might have heard of 529 college education plans. That's where the money for college is not taxed. And then 7702 plans, and that's where you take advantage of the IRS code 772 for our insurances. And that means, again, this money have been taxed already because it came out of your paycheck, but the growth is not taxed and the usage of this money is not taxed. The growth is not taxed and the usage is not taxed. And that's key, because if you have to know about what to do. And is there other plans out there? There probably is, because they're always coming up like different things. And if I didn't put something down, we could show you where they would land on that, right? Because
yeah, Sean, Parkman just asked a question. What about HSAs?
HSAs, that's the health savings plan. Is that for health? Is if the person, you could unmute for a moment if you're, who asked that. Is that a health thing for health savings?
Yes, that's correct.
Okay. So if it's health, it's probably that you're depending on how it's pulled out, right? And right now, I don't know that one per se because it's not a wealth building concept, but either you're in a place where they took it pre-taxed. If they took it pre-tax, it's gonna be tax. It could be a tax-free zone if you use it for health. But if you use it outside of health, then it might be taxed, right? If it's after taxed, then and it's probably could be the same thing. Like, hey, you have to use it for health. If you don't, then make you have some penalties. So I'm going to say that I'm not 100% sure because it's health, but I could look that up for you with no problem. Okay.
That's cool.
Thanks, man. I appreciate that. Good question. Now, here's one thing that we want to look at. Let's say you had $1 million and you want to wait that for tax later, and you had 33%. That means that's all that money, over $330,000 going to be going to taxes. So that means you only have $660,000. So you can't plan on for $1 million. You actually have a plan for a little bit above 600,000, right? Which is a big difference, So you want to make sure that you're planning in any of this have protection, growth, safety, and tax-free benefits at the same time. Now, IRS code 7702, we kind of talked about that, been around for a while. It allows insurances to have money being built up without any taxes and for income or any taxing for capital gains, right? And when you use it, is no taxes. And this is some recommended reading for you to go out there and check it out. Retirement Miracle, Money Master the Game. Actually, there's a whole lot of books out there. Actually, I was just looking on Amazon the other day, and I mean, there's more and more books being written about it every day. So you want to go out there and get some good, if you want to get some education on it, is some quality materials out there. But let's talk about the infinite banking program, okay? Now, this is something new. This is where I say this is where the program or infinite banking been around since the 80s. However, this variation of it is very powerful. And what happens is that you get life insurance to take care of you if you get sick, or if you're of course you get permanent life insurance because it's a whole life policy, and they also have long-term care riders connected to it. So that's the insurance side. So you take care of if you get sick or if you pass away. And that's important because that's an important thing about insurance. And that allows the money and the savings to have guaranteed growth and dividend growth at the same time. Guaranteed growth and dividend growth. And the thing is that depending on the company, the floor could be 2% or even higher. We have some almost actually at 4%. But you could have the dividend growth even growing. I've seen people have paid out at 10% of the dividend growth. Now, here's the thing. This is a powerful, powerful program for you, and a great way to take your money that you're putting in there and build it tax-free. It's a little bit different. I'm going to kind of walk through some then IUL. Some people might have heard of it, or your 401k, and we're going to kind of do an example of this, looking at the index or the so like if you hear an index like S&P 500 or NASDAQ, Dow Jones, those are indexes or the market, and how they compare and how the power of this policy can build you wealth over time. So let's say the indexes and the 401k, if you don't know, is a bunch of different funds inside of it. A lot of times you can match it to let's just say we look at the S&P 500 and you can match it to it, right? So that it's kind of looking at that. The IULs have a what we call a ceiling and the floor, and IBC is what we call it, the IBC type product. It also have that, what we just kind of talked about that. So if it was growing at 10%, everyone will pretty much get about 10% growth, right? If the following year, like say the market did amazingly well, 20%, your 401k will grow as high as it going to grow. 20%. Your IULs usually have a cap. Sometimes 15%, depending on the company and so on. Now, I'm going to put the IBC the same and stopping at 10%, but that's not necessarily true. They don't have a cap, but they could grow higher. But I've usually seen the dividends. I haven't seen it higher than 10% as of late. So I'm just going to kind of give you that example. But let's say if the S&P 500 crashes and you have negative 20%, what's going to happen to your 401k is a subtraction of 20% from your account. Your IUL will go down to the floor, so around 1%, let's just say. And I say in the IBC product because I haven't seen the dividends less than 5% ever inside the policy of the program. So they're giving about 5%. So they're giving you 2 plus, so let's just say 5. So if we did that again, like another negative downturn, you see in the numbers, right? If it was really a bad crash like 2008, that this is the power of where you have this type of program, your IUL, which we help people with in the IBC program too, that you could get 27 to 30% growth over that period of time, while other people could be losing money. And this is the thing, is that especially the IBC program, it allows you to really build wealth in a multiple different ways. That's why I love the program. Now, one of the things that I want to show you is supercharge your retirement by using your expenses like mortgages, car notes, credit cards, business loans, personal loans, rent, household expenses, and so on. That if you take some of that and you, instead of having your cash flow look like this, where all your money going to the bank, you pay all your stuff, and then you don't have no more money, that we actually have a program where we can show you through the IBC program that you actually put the money through your personal bank. You actually start building your own bank. And sorry for the misspelling there, that go right there. But and then also that bank, what they're going to give you is life insurance, living benefits, cash value, increase your estate value. And then your money going to earn interest, which creates a new interest state for you, right? You're building more money for you. And then you can take that money back out, give it back to your bank, and then pay your little bills. But because now that money don't go away, your money that you rotate through your policy stays in your policy and adds and grows at more interest. So here's the question: does it make sense to pay the cost of insurance so that your money can always earn additional interest? And that's the power of this program. People like like Walt Disney, Ray Kroc, J.C. Penney's, all these masters of industry have used policies like these to help build not only themselves up, but their business up. And that's one of the great things, and build towards retirement. Actually, they say that 80% of CEOs have some type of permanent type policy to help build their retirement planning, including people like and coaches and all the area. So with that, guys, right? I don't want to make sure I'm pulling this together. If you build yourself your own bank through your policy, you can eliminate debt, you can create capital, right? Now, imagine that using the expenses you have to create emergency funds for yourself, right? Most people don't have emergency funds because they can't find extra money. But if you use the money that you're already using to create that extra money, then you will have emergency funds, right? Then you could grow and use that money tax-free. And you could even reinvest that money safely, right? You could take that money and reinvest it safely. That's some of the information. That means that you could get higher rates of returns and still be protected, which is cool. And that's something that we'll love to talk to you about. Now, I'm about to stop my share here and just to come back and give this wrap up. But what I want you to, actually, I'm going to bring this right back up. I'm sorry. I'll bring this back up. What I want to do is say this, right? I know I just want you to think about these questions. Number one, did you see a value in the presentation? Did you believe other people could benefit from this information? And do you think this could benefit your friends and family could benefit from this, right? So, or can you benefit from it? So with that, what we would like to do, right, is if you have for the next minute or two, just want to keep it there, the time frame. If anyone have any quick questions, I'm more than happy to answer anything. Yes, Chris Parkman.
Yeah, I just like like being your own bank. I guess I just have to kind of like see how the process would work with that. Because I mean, I would love to do something like that. It's just like seeing it. Like, sure. I think a lot of times, like we if we're not holding it or we don't feel like it's like tangible, you know, like when people, like even when we use like 401ks, right? Everybody, I don't think utilizes that space a lot because they're like, I don't see my money doing anything, or I don't see how I can touch my own money, you know?
Mm-hmm.
So I think for me, I would like to do my own banking, like in the diagram, like you showed, but it's just, how can I do that? I guess I just need the steps to get there to do that.
Well, number one, this is number one. First thing, that's a great question. First thing, because when most people hear about that and saying, "Hey, I'm going to become my own banker," they're like, "Well, how can I do that? I don't have a whole bunch of resources. I don't have, you know." When they hear that, they're not able to comprehend it completely, because that's not what we are taught, right? We are taught to be consumers. We taught to be going to the bank. We taught to, hey, you know what? You know, even if you have money in the bank, you might not even get a loan and all that kind of stuff, right? I'm just being honest. That's my relationship, right? So, hey, this is the thing. This is the thing that you have to realize, that you have to take power into your own hands and what you can do. So here's the power of that, is that taking that IBC concept, which is an infinite banking system, or concept, where you could funnel money through and you could get that back. And I know some of you guys might understand cash value insurance and so on, but most of the time you have a long period of time before you can get to the cash value. The power of the IBC system is that your access to the money is right away. So your cash value is there basically in the same month that you could access back out. That makes sense. So really, one of the things is, of course, you have to go through and that's what we do. And so for anyone here, if that's something that you want to get more information, that's where we do the illustrations. We show you how the money rotates, and we walk through that very carefully with you, because you want to make sure that you're doing that. But think about this, Chris, and anybody else that's out there. You're putting your money in a bank right now that's getting you less than 1%. If you have any savings at all, right, and you have it in a savings account, and again, less than 1%, is not doing anything for you. And if you agree with me that the banks are not, right now is not really, I'm not going to say it's not on your side, but they're not advantageous to the average person just going to the bank. So what if you could just change that part, where you're funneling your money through something where you're taking it back out almost all the time anyway, but funneling it through something that could get you somewhere closer to 4%. That's a 400% growth, right? And the thing is, the thing is that when you put it through the policy, is that it holds your money, and we can show you how to hold your money and then leverage it. And that's the power, is that the difference between wealth, to people who have built wealth, that they have leveraged money at some point in time. Everyone that became wealthy leveraged some money to make it more money. That makes sense. And what we're showing you is that average person can do it too, safely, and do that too. But that's a great question, Chris. So what I want to do is make sure we get together and follow up. And I could make sure and break that down for you, because everyone will be different. Everyone will be different. Okay. Yeah, but I'm glad. That's a great question.
Sean, if I understand what you're saying, hey, you're essentially investing in a policy, and even if you take money, a loan against that, and use that and never pay that back, your policy amount is like a home that's appreciated in value. That policy continues to grow, and you're making money on that policy, even though you're pulling money out that you can reinvest with. So that's kind of what I'm hearing.
Absolutely great, and it's very. I'd like the analogy to put into the home, because like your home, which should increase in value, even if you took a loan on against it, it still should increase in value, right? Right. So your policy actually is one of the few things that anyone could get that will increase in value, even all the time. And I mean, that's something that everyone should have. And you said it very, very well. Anyone else have a question or a hand raised? I
got a bunch of questions.
That's great.
A follow up? You said follow up question?
I guess how do we avoid the pitfalls of there being like like there's a billion vehicles where we could put our money, right? So why is this vehicle like this not as dominant as the 401k or the IRA or CD? Like it's just it's everything's in front of this, and then you don't really get this type of information unless you get invited to something like this, or you talk to that person that has wealth or whatever. Nine times out of 10, most people I know that have a lot of money and doing what they want to do and all that stuff like that, they don't even mention the word bank. So it's so I'm trying to get to like that level. You know what I mean?
Well, you know what? I think one of the things you just said, well, why is certain things put out there more? And not trying to be a conspiracy theorist. So I'm not going to get to the exact part, but I'm going to say this, right? There's certain things done for a reason. If you look at the 401ks and the growth of 401ks, I did a lot of research on the growth. And by the way, 401ks, IRAs, all this stuff, none of them's bad, right? All of them is useful. But what the great thing about 401k and our market and the U.S. economy, that if you put your money in the 401k, it helps the U.S. economy, right? So the U.S. so it's now a promotion of that. Even though you're completely ignorant of how to use your 401k, most people don't know anything. It's completely sad. Actually, I shouldn't be laughing, but it's completely sad about the lack of understanding what people know about their 401k. However, when it came out, and if you looked at the growth of the market, and when 401ks hit, both of them goes up exactly the same at the same time. The market explodes, and when the 401k came out, and then pension stopped, right? Why did pension stop? Because they say, hey, why would companies pay you for your retirement when you pay yourself with a 401k? That just don't make it makes less. I could put in 20% versus your whole retirement, right? I mean, even military now is doing that. Government is now getting towards that position because they're not. So they're taking it out of their hands and putting it into the market. If you put money in the market, that means it's quote unquote good for the country, right? Well, good for companies anyway. And of course, that's going to make money go around. So that's why 401ks are well known. I mean, you're gonna find I'm not again, 401k is nothing wrong with it. IRA is nothing that. But compared to this, which is a little bit more private, because you're putting your money in an insurance policy or whatever. Actually, it's amazing that we don't talk about insurance in period, right? Because if people was insured, they will have money passed on instead of, and that would be more wealth. You would think that would be more, but that doesn't make the general market make more money, right? So it's not promoted like that. So in my opinion, that's just my opinion. So if you want to know why this is because it's private. It's by private insurance companies. Different companies do it. And therefore, because it's that private size, is not promoted in the same way. Okay. I see a hand by JB. JB.
Yes, Sean. Yes, I just wanted to add on to what you were saying. Yeah, basically, how I see it as if everyone was doing this, what would be so special about it, right? It's one of those things where if you know, and if you don't, unfortunately, you don't, right? A lot of, and what I realized is a lot of people that have large amounts of wealth, they don't even know how to use life insurance to, like you said, legally avoid taxes, et cetera, right? So in response to the gentleman that was just talking, that might be why you might not hear much of it, why they don't teach it in school, is because a lot of people don't know about it, but the ones that do, they share with each other, right? Their families, their friend groups, and it's kind of private. Like Sean says, it's private, right? It's private information. It works and it's good, but
Very good.
Yeah.
Thank
you. That's all I had to say.
Thank you, JB. breaker. All right, I see the hands are now going up. Okay, Mr. Manuel Hope Foundation. You have your hand up, sir?
Emmanuel, are you there?
Yeah, I was trying to unmute myself.
Okay.
If I understand correctly, Sean, first of all, many people may not be familiar with this banking process is because it is a new concept. I know prior to me learning of this concept, the IUL was pronounced in my mind and something that was an exceptional vehicle for sheltering your wealth from taxation, as well as, growing your wealth tax-free. So this is a new concept from my understanding. So of course, something new, it takes time for it to permeate through the community and for people to have and receive this information. Is that correct?
Yeah, I'm going to say two things, right? The IBC or infinite banking system, or putting your money through with whole life policy or something like that, has been around since the 80s, actually. However, this version of it is like the vehicle of this, or the chassis of this, is new, right? So we're able to do more things now. It's kind of like just like their electric cars now, right? They're not that the car is new, but the electric car is now new, right? And actually, I was just watching something with like Ford is going all electric. You know what I mean? Not Ford, right? And so what I mean by that is this is what we're bringing to some things is that the ability to get to the access to the money right away is new. That wasn't always there. The ability to now fund it with expenses that you already had, because you could get to the money right away, so you don't have to just try to put extra money that you didn't, that you're trying to find, that you wasn't doing nothing, right? Those things are new. So those concepts are new. Those are the electric engine, the fact that you don't have to use gas no more because you could just charge it up, but at home kind of thing. That's new, right? But the concept of IBC been around since the 80s.
Yes, it does. So my question is, that was just something I wanted to mention, but my question actually is centered around quantifying and being able to calibrate on a monthly basis the amount that you are putting in your policy and how that amount is growing, because you are on a consistent cycle of putting resources in, because you're actually paying your monthly bills through the policy in order to maximize the growth of it. But how, when you have so many small bills, going through large bills as well, and then you're borrowing, is this one loan that continues to grow on a monthly basis in its amount?
We didn't talk. I'm going to say this, because today we didn't get into the whole loan amounts and stuff, but that's one of the things I'm going to say with everyone, so that make it simple. When we sit down with you, that will be completely explained. But your loans are one thing about this, you're going to make money on your loans. So this is the only loan I have ever seen where you will make money. I want to be clear that I'm saying that you might not understand all the basics of it, but I will show it to you on our illustrations. When we do that, you will make money on your loan. So if you put $1,000 into your policy and your policy is gaining 5%, let's say per se, 5% plus dividends or whatever annually, and then you're taking a loan out that's a simple interest loan. Basically, long story short, you're gonna make money on the loan. You're gonna make more money that's inside the on the ledger, we call it the ledger, or inside your account. And that money gonna grow faster than the money that you took a loan on. So you're gonna make money on the loan, right? You're gonna be able to get the loan back out, right? And we'll show you how we're not gonna go into the minutia or what they say all the super details, because each person might do this a little bit differently. But you're gonna basically know what you want each month, and you're gonna pre-plan that. So whatever plan that you're gonna do, you're gonna pre-plan it. You can say, hey, I want to get $700 out each month or whatever. You're gonna be able to have that there to take that back out each month, right, to pay your bills. But we know that $700. So month one, that $700 there. Month two, that's now 14. Month three, that's 21. Month four, that's 28. That you're getting interest off of that money, even though you took that money out. So that's the key part of that. The money still grows while you're taking the loan out. And if you need we're coming about 5 minutes away to close up. But this is my thing with each person. If you're a guest, make sure you set a time with the person who invites you. If you haven't yet, text them right now. If you see a guest that you have here, go ahead and text them and make sure that you have a time. Like Chris, text me. We're gonna talk in the next couple of days. Some of y'all, as I have talked before, but I definitely want to make sure. That's a great question, Emmanuel. But the key of it is your money that's being saved is going to grow more than the money that you're taking a loan on. Okay.
Sean, would you mind putting your phone number in the chat so everyone has that?
Sure, yeah.
Because I know some of the people might have responded to the ad that we put out, and I know that Jamal had his hand up, and then also Mario.
Yeah, so those will be the last two people. Thank you.
Okay.
So Jamal?
Well, I'll let everybody else go. I was just going to say that, great presentation, and I really appreciate it. I just started with this, and I'm working with Sean, and it's really making a lot more sense as you continue to go through it. So I would say, thumbs up and really contact the person who invited you, because this is it really is helping me. So, I would I'm just thumbs upping.
Okay. Thank you, Jamal. And Mario?
Yeah, I guess my question is I know we only got 5 minutes, a little more detail, and I kind of missed the beginning of the presentation. So I'll reach out to the person that invited me, and hopefully I can get a little more clarity, because you kind of touched on it about paying your bills through the vehicle. Mm-hmm. But I guess the concept in my mind, if I just have a savings account, and I always put, every week I put in, $200. If I use the policy the same way, I'm not pulling it out every month unless I need it or there's an emergency or whatever. Would I still be able to, I guess the value of the loan that I'm going to pull out, you said it has to be preset. So I have to already in the beginning say I'm only going to take out, the most I'll take out is $700 a month. But what if something comes along, or a car breaks down, and I need $3,000? Would I be able to do that?
Yes. So let me just say this. Who invited you, Mario?
Reginald Ray.
Oh, okay. Great. Yeah. I know. I saw when you came in a little bit later, and you definitely. We just need to review a little bit, and you'll probably catch that. But what I was saying with that was, like, if you was doing a specific bill or something like that, let's just say, like we showed this, we didn't show this today, but let's just say you was doing something like you took your car note and you wanted to knock out your car, but you're paying, but you're through this system. So what I have shown people to do, hey, the car is like $700, they're putting it in their policy first. Plus whatever other money they want to, they know they're going to take out $700. That makes sense. They know they're going to withdraw that every month. So that in their mind, they already know. Now their money is growing. Let's say they're paying $1,000 every month, whatever. Their money is growing, with whatever money that's growing there plus interest. That makes sense. So the whole key of this is to build yourself emergency funds. Actually, that $700, like right now, if you had it in your savings account, and you pay your money, actually, right? That money is gone, right? It has no more earning potential. What we're saying here is that if you funnel it through your policy, it's gaining interest, even though you're using it. Because
okay,
right.
I got you.
Right. So now that's like growing and giving you interest for you, right? That building your. So it's kind of like you was using something that was going to be wasted anyway to build you more money.
Okay.
Oh, and by the way, Sean didn't share this, but death benefit.
Oh,
which is huge.
Hey, so, well, we saying this like we started all this. You're absolutely right, David. Hey, look, plus death benefit, plus living benefits. Shoot, right? Home care. You know, like different living benefits that people need. There's a lot of benefits to this. So you're absolutely right. Thank you. We don't want to lose that. It's all a plus of that, right?
You
So
pass away, you leave a legacy. It's not taxed.
Yeah.
Dividends.
Yeah. Oh man, it's a lot. So Mario, what we need, I need you to do. Remember, I said this. I need you to Ray, if you're on. You know, y'all need to make sure you connect. Please, in the next 3 days, I'd love to get a chance to talk to you, Reggie, and we could get a chance to talk to you and go into more detail and give you
I'm
some
here.
information. Okay.
Oh, that's
Okay.
you, Reggie. Okay.
Yeah, I've been in the car, been moving around. There's been a lot going on today, but yeah, I'm here.
Oh, yeah, iPhone. All right, iPhone. Hey, you know I don't like iPhones. I'm gonna make you change to Samsung. No, that's all good. Absolutely. Hey, look, with this, I'm about to wrap up here. I just wanted to say I appreciate everyone that was on here. I thank you for your time. The questions were great. If I didn't get your question answered, please, hey, well, really, that's the next step. Honestly, everyone that's a guest, that's the next step, is to get back with me. Get back with the person connected you. I will be on that, you know, try to get back with you too. I'm here to answer those questions, just walk you through, redo the presentation, but you know, to that extent so that you hear it. But I really appreciate each one of y'all time. I thank you all.
Hey, Sean, I don't know if you
Uh-huh.
put your number in the chat.
I did.
I didn't see it come through.
Let me, maybe it went to someone. Okay, here we go again. So I did. It must have probably went to someone personally. But yep, that's my telephone number. You can always reach me. But then again, I definitely want to make sure you reached out to the person that invited you and make sure that you follow up. I thank you for, and so all of my our Rising Business Solution reps, I just want to hold back, if you all can hold back, but I wanted to let all you, everyone else go.